There is a tragedy playing out in the American economy right now, but nobody is talking about it. We are raised with a very specific script. From the time you are 20 years old, you are told to be an accumulator. Buy the big house, fill the garage with cars, buy the insurance policies, stuff the 401k with mutual funds. We are taught that more equals wealth. But there comes a moment, usually around age 50 or 60, where the math flips upside down. The very things you bought to make you feel rich start to make you poor. The assets you work so hard to acquire turn into liabilities that drain your cash flow. I call this the accumulation trap. I recently audited the finances of a gentleman named James. James is 58. On paper, he is a millionaire. He has a net worth of $1.8 million. He walks around his country club feeling successful. But when we looked at his bank account at the end of the month, James was broke. He was house poor. He was car poor. He was fee poor. His $1.8 million net worth wasn't paying him. In fact, he was paying it. He was a slave to his own possessions. We are entering a period of sticky inflation, higher for longer interest rates, and a cost of living crisis that is punishing inefficiency. If you are holding on to dead equity or depreciating metal, you are bleeding to death. And you don't even know it. Whether you are 25 and trying to build freedom, or 65 and trying to preserve it, you need to stop buying and start pruning. Wealth is not just about what you make. It is about what you keep. Today we are going to perform surgery on your portfolio. We are going to identify the 5 fake assets that are destroying your financial future. We are going to run the math, the brutal, honest math, on why you need to sell them immediately. Some of this will hurt your ego. Some of this attacks the American dream. But if you want to be free, you have to let go of the heavy baggage. Let's look at the first and biggest vampire in your life. Asset 1, the dream house. The equity prison, liability number 1, dead equity. The first asset you need to sell is likely the one you're sitting in right now, the big house. Now, before you click away, hear me out. We have been brainwashed to believe that our primary residence is our greatest investment. Robert Kiyosaki was the first to punch a hole in this lie. He said, "Your house is not an asset. It is a liability." Why? Because in strict financial terms, an asset puts money in your pocket. A liability takes money out of your pocket. Unless you have tenants in your basement paying you rent, your house is a liability. It eats cash. But for the person approaching retirement, the big house is something even worse. It is a capital prison. Let's run a case study. Let's say you own a home worth $900,000. It's paid off. You feel proud. You have $900,000 in equity, but you're living in 3,500 square feet. The kids have moved out. You use maybe 3 rooms, the kitchen, the bedroom, and the living room. The other 2,000 square feet are just storage for dust. That $900,000 is earning you 0%. Actually, it's worse than 0. Property taxes in 2025 are averaging 1.5% to 2% in many states. So on a $900,000 house, you're paying $13,000 to $18,000 a year just to the government. Insurance rates have skyrocketed. Add another $3,000. Maintenance is 1% a year. That's $9,000. Utilities to heat and cool empty rooms, another $4,000. So your paid-off house is costing you $30,000 a year in pure cash flow. It is a negative yielding asset. Now imagine the alternative. Imagine you sell that house. You take the $900,000. You buy a smaller, comfortable condo or a small home in a cheaper area for $450,000. You have freed up $450,000 in cash. If you put that $450,000 into the never sell portfolio we discussed, yielding 5%, that generates $22,500 a year in passive income. Look at the swing. Scenario A, quit the house. You pay $30,000 a year. Scenario B, downsize. You earn $22,500 a year, and your new smaller house costs half as much to run. The difference between those two lifestyles is nearly $50,000 a year in disposable income. That is the difference between a retirement full of stress, wondering if you can afford to fix the roof, and a retirement full of travel and freedom. This is what I call return on equity, ROE. Corporations track ROE religiously. If a factory isn't producing profit, they sell it. Why do you treat your own net worth differently? Your $900,000 equity has an ROE of -3%. It is a bad business. The ego wants the big house to impress the neighbors. The neighbors who, by the way, are probably broke too. The wealthy architect wants cash flow. Sell the museum. Buy your freedom. Liability number 2, the 2% fee. The second thing you must sell immediately is a financial product that has likely been in your portfolio for decades. High-fee active mutual funds. If you have a 401k, or if you use a traditional financial advisor at a big bank, you need to pause this video and go look at your statements. You are looking for a number called the expense ratio. If you see a number like 1%, 1.5%, or nearly 2%, you are being robbed in broad daylight. Now you might be thinking, 1% is small. What's the big deal? I'm making 8%. So who cares if they take 1%? This is the greatest trick Wall Street ever pulled. They rely on the fact that the human brain is bad at exponential math. Let me show you the true cost of that small 1% fee over 30 years. Let's say you invest $100,000 at age 35. The market returns 7% a year. Scenario A, low-cost index fund, 0.03% fee. By age 65, your money grows to $760,000. You keep almost everything. Scenario B, active mutual fund, 1.5% fee. The fee reduces your return from 7% to 5.5%. By age 65, your money grows to $550,000. You keep almost everything. Your money grows to only $498,000. The difference is $262,000. Think about that. You put up 100% of the capital. You took 100% of the risk. But the fund manager, who took zero risk, took 35% of your final wealth just because of that small fee. That $262,000 is a Ferrari. It is 5 years of retirement spending. It is a college education for 2 grandchildren. And you handed it over to a guy in a suit who likely underperformed the market anyway. Data from S&P Global shows that over a 15-year period, nearly 90% of active fund managers fail to beat the market. So you are paying a premium price for a defective product. It gets worse. Active funds have high turnover. They buy and sell stocks constantly inside the fund. In a taxable account, every time they sell, you get hit with a capital gains tax bill at the end of the year, even if you didn't sell a single share yourself. They are generating taxes for you while charging you fees. This is a liability masquerading as an asset. The fix: sell these funds. Move that money into low-cost ETFs like VOO, S&P 500, or SCHD, dividend growth, where the fees are 0.03% or 0.06%. Stop paying for your advisor's BMW. Keep your compound interest for yourself. Liability number 3, the ego toy. Asset number 3 is the ultimate middle-class trap. The second car, or the retirement toy. The boat, the RV, the Corvette. We live in a culture that worships vehicles. We view them as extensions of our personality, but mathematically, a car is a depreciation bomb. The moment you drive a new luxury car off the lot, you lose 15% to 20% of its value. But the real cost isn't just the purchase price. It is the opportunity cost. Let's talk about the driveway ornament. I see so many retirees who have 2 or even 3 cars, but you aren't commuting to work anymore. You drive to the grocery store. You drive to the doctor. You drive to visit the grandkids. Can you do that with one reliable car? Yes. Let's say you have a fun car worth $40,000 sitting in the garage. You drive it on Sundays. You are paying insurance $1,500 per year, registration $500 per year, maintenance $1,000 per year, and the car is losing value by $4,000 a year. That car is costing you $7,000 a year to own, even if you never drive it. Now let's invert the situation. If you sell that car for $40,000 and invest it in the never sell portfolio at a 7% total return, in 10 years, that $40,000 doubles to $80,000. In 20 years, it is $160,000. By keeping the car, you are guaranteeing that $40,000 goes to zero. By selling the car, you're turning $40,000 into $160,000 of legacy for your family. Rich people buy assets that appreciate: stocks, real estate, art. Poor people buy assets that depreciate: cars, electronics, furniture. And don't tell me. I need it for emergencies. In the age of Uber and Lyft, holding a $40,000 asset for a $20 ride once a month is bad math. You could take an Uber every single day for a year and still spend less than the cost of owning that second vehicle. Be ruthless. If it has an engine and you don't use it to make money or drive every day, sell it. Number 4 is controversial. I will get angry comments from insurance agents on this one. But I don't care, because you need to know the truth. Whole life insurance, or universal life, or variable life. Unless you have a net worth over $13 million and you're doing complex estate tax planning to avoid the death tax, whole life insurance is almost always a mistake for the average person. Salesmen love to sell it. Why? Because the commissions are massive. Often 80% to 100% of your first year's premium goes straight into the agent's pocket. They pitch it to you as an investment. They say, it builds cash value. It's tax-free. It's banking on yourself. It is not an investment. It is a very expensive savings account with a death benefit attached, wrapped in fees you cannot see. If you look at the internal rate of return on these policies, it often takes 10 to 15 years just to break even. That means for the first decade, you have made 0% return on your money. In a world where the S&P 500 averages 10%, getting 0% is a financial disaster. For 99% of people, the correct strategy is buy term and invest the difference. If you are 35, buy a cheap term life policy to protect your family if you die. It costs pennies compared to whole life. Take the thousands of dollars you save on premiums and buy real assets. Real estate, stocks, Bitcoin. But here's the kicker for my audience over 55. Why do you still have life insurance? Insurance is meant to replace your income if you die, so your family doesn't starve. But if you are retired, you don't have a salary. Your kids are grown. Your house is paid off. Who are you protecting? You might be paying $500 a month to protect a financial loss that no longer exists. That $500 a month could be income for you to enjoy your life now. Check your policy. See if it has cash value. If it does, consider cashing it out, surrendering the policy. Take that check, invest it in the 3-pillar portfolio, and become your own bank. Stop betting on your own death. Bet on your life. Liability number 5, cash. And finally, the most dangerous asset of all. We touched on this in our first video, but we need to go deeper, because the data is alarming. Excess cash. I meet retirees who are sitting on $100,000, $200,000, sometimes $500,000 in a checking account, just in case. They think cash is safe. They think cash is king, but in a fiat currency system, cash is trash. Let's look at the history. Since the Federal Reserve was created in 1913, the US dollar has lost 97% of its purchasing power. It is designed to lose value. That is the feature, not the bug. With national debt spiraling past $36 trillion, the government has only one choice: inflate the debt away. They have to print money. When they print money, your savings account gets diluted. If your bank pays you 4% interest, but real inflation, food, energy, services, is 7%. You are losing 3% of your wealth every single year. It is the boiling frog. You don't feel the heat until you realize you can't afford a hamburger anymore. You need an emergency fund. Standard advice is 3 to 6 months of expenses. That is sensible, but anything above that is lazy money. It is money that has quit its job. If you have $200,000 sitting in cash, you are losing approximately $14,000 a year in purchasing power compared to real inflation. You must deploy that capital. It must be in high-yield savings, at the very least. It must be in short-term treasuries, T-bills. It must be in dividend aristocrats. It must be in physical gold. Do not let your hard work evaporate because you were too scared to invest. Safety is not in the bank. Safety is in ownership of productive assets. I want you to visualize your financial journey as a hike up a steep mountain. The goal is the summit, financial freedom, peace of mind. But right now, many of you are trying to climb that mountain wearing a backpack filled with rocks. The big house is a 50-pound rock. The second car is a 20-pound rock. The mutual fund fees are leeches draining your energy. The cash is leaking out of your water bottle. How can you expect to reach the summit carrying all this dead weight? You can't. You will exhaust yourself before you get there. Wealth is not just about addition. It is about subtraction. The fastest way to give yourself a raise in retirement is not to pick a winning stock. It is to cut the liabilities that are masquerading as assets. This week, I challenge you to take an audit of your life. Look at your garage. Look at your statements. Look at your house. Ask yourself the Munger question. Is this making me richer, or is it just feeding my ego? Be ruthless. Prune the dead branches so the tree can grow. If you are ready to take the cash from these fake assets and move them into real assets, you need to watch this video right here. I break down the exact 3-fund portfolio that generates monthly income without selling shares. It is the blueprint for where to put that $400,000 from the house sale. Click here, and I'll see you in the next class.